Hello and welcome to another episode of Working Dad Trader. In this episode, I wanted to do a video about the huge potential growth in the sectors of countries of China and India. No one's really talking about these sectors, especially India. There's a bit talked about China, but not much talked about India. This massive, huge potential growth that I see personally in these two areas. The two biggest populations in the world are China and India. So to me, this is where we can also be looking, and to sort of, when you want to diversify your portfolio, I personally would like to have some of my money in these sectors. I personally hold ETFs and index trackers in China, and I also have one on the Indian market. There are a few companies, Chinese companies, that are listed on the US market, which is obviously easy to buy. People like Alibaba, Tencent, etc. The Indian stocks are a little bit more difficult. There's not really many out there, and to lower my risk exposure for the minute on the Indian market, that's why I decided to go with ETF. Again, I'm going to talk about the positives of these sectors. This is just my own personal opinion. This is not by any way financial advice. There are risks, and probably higher risks than just trading in the US or UK markets. But I see massive potential growth. Like I say, it's not financial advice, it's just my own personal opinion. Lots of people in discussions on different social media platforms have been saying to me that I need to be really brave to invest in China or India, or it's just a fool's game, etc. There's lots of complications. The Chinese government is too controlling over the Chinese stocks, etc., etc. At the end of the day, a lot of what you hear is Western spin, and especially the US, because the US want to keep their market as the strongest, and they see China as a threat, etc. So to me, I'm just going to block out all the noise and just go on what I see and look at the stats and see how much money these companies are making, etc. And when I looked at the ETFs and index trackers that I'm using, and I'm looking at their past performances, they're really quite good, and I'm quite happy with the returns. Like I say, I'm only exposing a small amount of my money, of my own personal portfolio money, into these sectors. And just because I want to diversify, I've got some in the US, quite a lot of my money in the US market, and then I've got bits now in China and a little bits in India, just so I've got a really good mix. Okay, so remember, for all the research and effort I put into these videos, it'd be really kind if you could hit the like button and subscribe. And for all the people that have already subscribed to my channel, thank you very much. And let's go and have a look at why I think these are great sectors to be in. So this is a report done by JP Morgan, and it's quite a sort of in-depth, lengthy report. It's quite a long read, but it's some fantastic bits of information in there, really useful stuff in the report. And these are just some of the clippings from the report. And when we're looking at the Chinese and the Indian economies and the markets, and why me personally have decided to have a bit of exposure to these markets. When we look at this JP Morgan report, and they're looking at the growth of the world's middle class and where this growth is going to really come from, and with that, is going to be, as in when they become more middle class, they'll have a lot more money to spend and will be looking to spend their money. And we look at some of these charts. I mean, we look at China. The purple is 2020, which was only last year. 41% of their population was middle class. and they're predicted for 2030, which is less than 10 years, to rise to 72% of their population will be of middle class. And then we look at India, which is just, the growth rate is just crazy. And we look at 2020, which is the purple line, which was 21% of the population of India is classed middle class. There's lots of poor class people in India, and then there's some very, very rich people in India, but it's mainly a lot of poor classed people. And that in the next less than 10 years, that's expected to go from 21% right up to 79% as the economy is really going to grow in India. It's going to really explode. These are the predictions from a lot of these people, from the experts at JP Morgan. So I found that really interesting, that the middle class is going to explode in India, and they're going to have a lot more money, and the economy is going to grow. So that's going to be a good thing for their economy, their stock market. So that was really, really interesting. If we also look at where a lot of the growth is going to come from on the second chart, these are in millions of people. This is the growth of in the next sort of 10 years. India is going to contribute around 883 million people are going to suddenly become middle class. China is 453 million in the less than 10 years. When you look at sort of North America, it's only 10 million people are going to become, the middle class sector is only going to grow by 10 million more people. Europe's minus 3. So there's not going to be a lot of growth in Europe, they're predicting. And then you've got the next best one, which is possibly Africa and the Middle East, which is minute compared to where the growth is in Asia. So that is a really strong sign of where the massive economy growth is going to come from. And to me, that's why I'm looking at ETFs and indexes in China and India. Also, if we go down the page and we look at another page, I think it's page 67, which I found really interesting. This is to do with the Chinese market. And it's this one here, China's Singles Day versus all the US holiday sales. So China has one sort of day which they call Singles Day, where the US has Prime Day, Black Friday, Thanksgiving, Saturday, Sunday, Cyber Monday, where they really go out and they have big shopping days in the US, where China has just one big day which is called China's Single Day. And they're just comparing the amount of money that these special, really good holiday shopping days generated. If we look at 2019, total sales of all American holidays was fairly similar, 35.7 billion, and this is in US dollars, compared to China's one day, which was 38.4. So it's fairly similar. But look at the difference in 2020's report. Total of those holidays in the US, where it's really big spending times for the US market and the retailers, 44.8 billion, compared to, look how massively China's has shot up, 74.1 billion just off one holiday date in China's calendar. 74.1 billion was spent on that special holiday, and that's going to be through lots and lots of companies like Alibaba, two indexes in China, in the stock exchange in China. They are the Shanghai and the Shenzhen. If we look at the technicals, this is the chart of the Shanghai. In February, it was at its all-time high. On the 18th, it's since dropped roughly around 10% since that date, and it dropped quite a big pullback right down to the bottom, but it's found support at this level, and that's been a support level in the past, going all the way back to November of last year. So the support level seems to be a reasonably good one. Obviously, it's not guaranteed, but it seems to be a support level. It's also of late been struggling to break above this resistance line. So it's sort of gone down, hit the support, and it's sort of going sideways since the 9th of March. So we're waiting to see if it can break past that line to start going back up again. So at the minute, you could argue, but it's a reasonably good time to invest, especially once you get signs that it starts breaking through the resistance. Then once it's got past that, then it could go way back up. So that would be a technical point of view with the Shanghai. The Shenzhen is pretty similar. Its all-time high was on the 10th of February. It shot back, obviously had a massive pullback again of sort of 10-11% to its bottom, which was down here. And again, it's found resistance, sort of familiar resistance of, it's been resistance in the past of sort of this area back in November of last year. So it seems to have bottomed out, and again on a sideways move. And I can see it going back up again. So that would be the technical analysis I would look at when looking whether to invest in some type of ETF or an index fund tracking the Chinese markets. It has two stock markets, the Nifty and the Sensex. This is the Nifty 50 index. As you can see, it's been on an upward trend for quite a while, up into it got to its all-time high at the 16th of February. Since then, it has been on a gradual downward trend, going down. It's sort of been in a downward channel. And with the Indian market, I think a lot of this has been affected by I'm not sure whether it's the second wave or third wave of the virus that has hit India quite hard at the moment, and I think this is affecting their economy and their stock market at the moment. And it's like I say, it's on a slow downward trend. It's unlike the Chinese market. There isn't any real clear support levels. Possibly the one that I've put in there is a support level. It's a bit more tricky to gauge. What I would say, it's obviously at the bottom of the Bollinger Bands at the moment, and at some point it will have to spring back to the middle of the Bollinger Band. So it could make its way all the way down before we see an upturn in the market. So that's sort of looking at the technical point of view. It has been, like I say, previously been on an uptrend for quite a while. So there could be some buying opportunities here if you wanted to get into an index or an ETF fund, because it's dropped at the moment. I think from its previous high, it's down about 7-8%. The Sensex index is very, very similar to the Nifty. It was in a massive upward trend for a long while, in an upward trend. all the way up because the market was doing so really well. Similar situation, 16th of February, it's got to its all-time high. And then it's been in a channel on the way down for quite a while. Again, it's almost like a mirror image of possible support at this level on its way down. The Sensex is actually not that far away from that support level, so it'd be interesting to see if that one does hit this support level and then start to rebound up. Again, it's at the bottom of the Bollinger Band, so at some point it will spring back up. It could go down for a little bit more. So there's potential to buy into this market if there's something that you're interested in, especially if it rebounds off this yellow line and starts making its way up. That would be a pretty good sign. Or if it breaks above this channel line, then also would be a positive move. So that would be it on a technical point of view. Okay, thank you very much for watching that video. I hope you got something useful out of that. And like I say, it's a sectors where no one's really talking about the Indian market, the Chinese market. There is, in my belief, potential out there, and there are returns and there's money to be made also in these sectors. Depends if you want to diversify your portfolio or you just want to stick to the US market. That's entirely up to you, it's your choice. If you did really get something great out of this, it'd be really great to remember to like my video and to subscribe to see more, and I hope to see you soon. Alright, take care.